Welcome to the Ellsworth Advisors September monthly update. I'm Kelly Keenan. This is Cameron Mealy. We're the managing directors of Ellsworth Advisors, and today we're going to talk about what's been happening in the markets, how the economy's been faring over the last month, and really give you a feeling as to what we see moving forward, how our portfolios have performed, and try and hit on the hot topics of the day, which, after a rough month in September, talk a little bit about this market pullback. So Cameron, why don't you kick us off with some economic statistics, and we'll go from there.
Thank you, Kelly. And if there is one thing you've been talking about, it has been volatility's here. Volatility's here. You were expecting it. It's certainly here now. We're seeing a lot of headline news. Headlines are moving the markets every day. Good morning, everybody. We obviously are now into the fourth quarter. Fourth quarter started on October 1st last week. And with this third quarter just ending, fourth quarter starting, we don't really have a lot of quarterly information. Still several weeks away from getting a lot of hard data about the third quarter. So not a lot of numbers to talk about. I want to talk about a couple more themes. And really the themes are, again, COVID, interest rates, and inflation. And when we look at the COVID front, we are starting to see the Delta variant wane a little bit. Hospitalizations are coming down, new cases are coming down. That's great news. Last week we got some really good news from Merck. I'm going to read an abstract from a press release. This is from Fox News, but this is quoting a Merck press release. Merck announced last week a new pill to treat COVID-19 and its application for emergency use authorization, which Johns Hopkins School of Public Health Dr. Ramesh Adala predicted could come to market by the end of 2021. According to Dr. Adala, if everything works according to plan, meaning the emergency use authorization, robust phase 3 clinical data, and all the signals look good, I think this is something hopefully by the end of the year we might see on shelves or be able to be prescribed to patients, and it would be a game changer. This is part of making COVID-19 something that we can treat like other respiratory infections, day in and day out, he said. We're looking to a better future with much more manageable COVID-19. So, obviously when this scourge came upon us, it wrecked the economy, wrecked the global economy. We now have prevention protocol in multiple robust vaccines. We now have what looks like a promising treatment protocol from Merck. Last week, Pfizer also announced that they're coming out with an oral pill to treat. So that should, hopefully with prevention, we cut cases down. With treatment, we cut down hospitalizations, ventilation use, death. That's all a great sign for the economy. That should help the economy, continue our opening up phase. And hopefully we're looking to a much more normal 2022.
I think that's probably the biggest piece of positive news that it's hard to say how much that's really priced in. Obviously, we know what's going on in the U.S. and we're in good position, and the trend for the pandemic is subsiding. The rest of the world, obviously that's a consideration too, but I think in general everybody's on the same path right now. So that's good from an economic returning to normalcy standpoint. But we're also in a situation, which you're going to talk about in a second, that, hey, some of the results of everything we've done, there's some other issues starting to percolate out there that need to be addressed. Mm-hmm.
So let's talk about, before we get to inflation, let's talk about where the Fed stands today.
Okay.
So this is from Market Watch. Last week, Philadelphia Federal Reserve President Patrick Harker said on Wednesday that the central bank may raise its benchmark interest rate for the first time this cycle in late 2022 or early 2023. He also said in a speech to the Risk Management Association that he supports starting to slow down or tapering the central bank's $120 billion per month in bond purchases in November and finishing sometime in the middle of next year. So this is something we've already talked about. The Fed stopping to support the economy, stopping to keep interest rates low by purchasing bonds. That will naturally lead to inflation. I still think it's fascinating that with the concern about inflation, some of the numbers we're seeing, that we might not see the Fed increasing the federal funds rate till the end of 2022 or even 2023. I mean, the Fed is going to keep the intrabank borrowing rate at basically zero for the next 12 plus months.
Well, the one reality is you have the bond purchases. If they stop doing that, seeing as we've never the Fed's never done this before. They don't really know what's going to happen when they stop purchasing bonds.
Yep.
So there's a big wild card out there. How much will that move rates? Obviously, once they start reducing those purchases, then we'll be able to start to get a better feel as to how does that influence interest rates. They know when they do change rates, they're doing it on the short-term bonds. We know what that effect is. If long-term bonds are staying low when they raise short-term rates, that inverts the yield curve, which some people believe that actually could put us into recession. Other people believe that's a sign of we're going into recession. That's the chicken and the egg question.
There haven't been a lot of positive outcomes when we've had an inverted yield curve.
No. So I think the thought process is let's taper, see what happens to interest rates before forcing one end of the yield curve up. Yeah. The theory is, okay, if the Fed's not buying bonds, rates should go up. The wild card in all that is with all the stimulus that's been produced, not just by the U.S., but by the rest of the world, there's definitely demand out there for bonds. That's what's keeping rates down so low. Mm-hmm. Is there enough demand to kind of step in what the Fed's doing? I think a lot of what the Fed's doing will be replaced by other countries, individuals, institutions. So a lot of that will get soaked up by the banking system. We just don't know what that extent's going to be. So we're definitely moving into some unknown territory with interest rates, with the Fed maneuvers, because these are non-tested theories that we're going to find out what happens. So it's not surprising to think, hey, first you taper, see how that goes, and then if we start moving rates in 22, 23, or late 22, early 23, which is kind of what we've been thinking, then that'll be more of a true, controlling of the interest rates. Mm-hmm. The reality is, from an inflationary standpoint, inflation is the price of all the spending that's going on. They're going to talk about raising taxes. Raising taxes will not pay for this. No. It only gets paid for through inflation. That's the way it has always worked throughout history. Whenever more debt's been brought on by governments, inflation is the way you pay for it.
You need asset prices to increase.
Right. And inflation, what that does is that brings down the value of debt. Mm-hmm. So it behooves the Fed to, hey, this is going to be temporary, drag their feet as long as possible, because the more inflation we have, that brings down the debt load. But they have to play the narrative game so that also does not freak out the markets. So we're going to continue to see, the inflation numbers I think are going to continue. They may get a little bit higher. Some of that inflation is the result of supply constraints on supply chain and just commodities in general. So that's caused some higher prices. But there are components of inflation that aren't going to go away, meaning like wage increases. If you give people raises,
you can't take them back.
You can't take them back. That just does not happen.
And that's the interesting dynamic that, originally a lot of the talk was, okay, the government spent a lot of money. We're trying to get out of this pandemic. That's going to lead to inflation, but it's going to be transitory. Meaning it's going to be temporary inflation just based on government spending. But the one thing we're seeing is, while we're having inflation, we've had a lot of government spending. We haven't had government spending in a once 100-year pandemic, which has created so many issues with the supply chain, with the supply of labor. It's almost as if inflation has transitioned from, it started with government spending, but now it's all about the supply chain. Whether it's chips in autos, whether it's workers at restaurants, whether it's shipping logistics issues and 350 cargo ships stuck at the Port of Los Angeles, we just can't bring in the goods. All supply trains have gotten screwed up. And, if you look at a simple analogy, McDonald's is a for-profit company. If they have to pay workers $2 more an hour to attract workers, guess what? It's not going to eat into their profit margin. They're going to pass that on to the consumer.
Right. And that's what we're seeing.
So I think inflation we're probably seeing inflation that's going to increase significantly over the next year or two.
Yeah, I think it's going to continue to go. It'll be transitory from the standpoint it's not going to be here for 30 years, but right. Transitory, that's all relative. Mm-hmm. The other issue around the supply chain constraints, and this is what I'm hearing from some of our clients who are in manufacturing businesses, they deal with global supply chains. The reality is, the expectations are a lot of this stuff's not going to get worked out till late 2022.
Yep.
So there's, this is not going to end quickly. So we're going to continue to see price increases. Obviously, once that gets resolved, that takes some pressure off the inflation piece, except for those parts of inflation that are going to be with us permanently. So we're moving into some interesting times.
And what this all is, the result of a lot of this is, what you're going to talk about, volatility.
Well, yes.
Every day there's some new piece of news that.
So what inflation's done inside the market itself, it's changed the nature of how investors, specifically, stock analysts, portfolio managers, are looking at their stock holdings. And in a higher inflationary environment, a higher interest rate environment, how you analyze companies and how you price companies, that's a big component of pricing companies. So with companies with a lot of earnings in the future become worth less because you have to discount them by the interest rate or the inflation rate. So now companies that have high price to earnings multiples, they're going to be pressured the most. So think about large tech companies or companies that are early stage, they're just beginning to grow, maybe not making a lot of profits or making any profits at this point in time, but they will in the future. Prior to this year, that was all right because, hey, there's not really a cost of money in the future. Now there's a cost of money coming in the future, so you can't price those companies as high. So we're seeing some challenges happening with the stock market itself, and just the way the S&P is structured, that kind of it's weighted towards those types of stocks with those high multiples. So that makes the stock market more susceptible to downside, and we've seen that volatility. We've seen fits and starts of it. I think the realities of inflation have finally set in, and we're definitely seeing a rotation away from the big tech stocks to your more cyclical or your more, call it stable companies that are, have strong cash flow now, are growing cash flow now, actually making money now, good dividend payers. That's where we're seeing money rotate to in the stock market. But because of the weightings in the indexes, the index can still be going down because money is shifting away from the heaviest weightings into the lower weightings. It's not enough to push the market up. That's why we've been positioned where we've been.
But those good quality companies will continue to grow.
Correct.
Despite the overall industry being down, there will be winners.
We're definitely going through some pricing adjustments right now. You have the inflation issues have become more headline issues. Throw on top of that, we're looking at a debt ceiling coming down the road real quickly. I mean, we're in the heat of that at this point in time. Driving in this morning, the talks about the debt ceiling, I thought I was having deja vu because this is the same script that, I've heard probably 6 or 7 times in my career, if not more than that. This happens every several years, and it's like the same commentary. It will get resolved. Yep. We have seen government shutdowns in the last. When was the last one? Obama administration?
Yeah.
Yeah. I mean, when it was shut down for, I want to remember, a couple of weeks,
and then
longer.
Then it was the GOP that didn't want to raise the debt ceiling. Now it's the.
Yeah. So this is nothing new. It'll get worked out. The U.S. is not going to default on their debt and become, have our hat in hands to the rest of the world. Not going to happen. Most people, you're not going to see any kind of change in life. Planes aren't going to fall out of the skies.
Well, and frankly, there's talk now about just eliminating the debt ceiling. Why have this arbitrary deadline that we have to go and argue about and waste time every couple of years?
Well, I think it's a disciplinary thing where it forces the conversation.
To everybody out there, you already know this, but the U.S. government has absolutely no discipline when it comes to fiscal responsibility.
Well, it presents the facade eases the minds of the market. Okay. Theoretically, who knows? So we have that coming, and then also the whole stimulus tax package, which has morphed into a lot of different possible permutations. Nothing is set there. There are talks of a lot of different tax changes. But to start planning for changes that are not law yet, it's really hard to do. But I think that's brought a lot of worry into the market. Seems like a lot of this stuff always happens in September, October. We saw a weak September. October is probably going to bring some more volatility with it. But in the grand scheme of things, I don't think we've seen the last of the highs to the market for 2021. I think there's some more highs still out there. We're going to get through this volatility period. And with the fact that, COVID's subsiding, we are still seeing global recovery. That definitely gives some tailwinds and some upside to the stock market. And we know there is more stimulus coming. It may not be $3.5 trillion. It may be $500 billion or $1 trillion, still, or $500 billion or $1 trillion. It's going to be something that's still going to add some fuel to the.
But do you think also,
to the market,
and this is an interesting question, do you think that that President Biden, do you think that President Biden will be able to push through tax increases in 2022? Just given that he is right now a pretty unpopular president, you've got a very polarized Democratic Party. You seem to have a GOP that's united against him. If you're a red state or a moderate Democrat, it's going to be hard for you in your Senate run in 2022 to go to your home state and say, I fought for tax increases.
There'll be some stuff at the margins that hits your highest earners,
But sweeping changes, I can't.
Sweeping, no. I don't see sweeping changes
until the end of November 2022, and we now have a clear path to the House and Senate. It's going to be very tough to get anything
Taking
through.
the top marginal bracket from 37 to 39.6, where it's been for most of my career, I don't think it's a big deal. Taking corporate taxes from
But taking capital
20 to 25%.
But taking capital, doubling capital gains is going to be.
But also you have to look at the income limitations or where that kicks in.
Yep.
Earners over $1 million in actual earnings per year, not $1 million in investments, in actual earnings. That doesn't hit a whole lot of people.
Yep.
And the reality is, people that does hit, there are going to be ways to address it, and they'll be able to, they'll be fine.
They always figure it out.
That's what we have CPAs and tax attorneys for. So there'll be ways around that. So I don't see those as being big threats to the economy. The biggest threat is this whole inflation surge that we're seeing. That has a lot of ripple effects, and the key with it is basically, how you're invested for it. And I think we're invested for the inflation. Doesn't mean we're going to make tons of money. It just means we're not going to lose as much, and we should be able to eke out some returns if things get pretty dicey. Let's jump into how our stuff did in September. Like I said, it was a fairly rough month. The Dow Jones in September was down 4.29%. The S&P down 4.79%. NASDAQ took a little harder on the chin because they're full of those big tech companies, down 5.31%. International markets felt the same thing. The developed world down 3.19%. Emerging markets down 4.25%. Year to date, after the pullback in September, the Dow Jones up 10.58%, S&P 500 up 14.68%, and both of those are, they're off their highs over 5%. So we're in the middle of a 5% correction, which we knew was coming at some point. It's been close to 18 months since we've seen a 5+% correction. It could get deeper. NASDAQ still up 12% for the year. Developed world, the MSCI EAFE up 6.25%. Emerging markets actually down 2.96%. So that's kind of how the markets have fared, how our portfolios fared. Growth with income portfolio. September, pretty rough month, down 4.2%. Year to date, we're up 8.23%. Where we're challenged there, we do have some tech exposure with Apple, NVIDIA. Apple's down this year, so that's kind of drug us back. Our big gainer for the month was our PIMCO commodity fund up 4.5%. That's why we have it, and that basically is addressing addressing inflation directly. Our laggards, Nucor down 15.58%, Lennar down 12.7%, Digital Realty down 11.21%. So we've given some back. Nike down 11.84%. Year to date, our big gainers still NVIDIA, still up 58.8%. Our commodity fund up 33%. That's the PIMCO commodity fund. Cisco, the tech company, up 24% still. And Lennar, even though we gave up 12% last month, we're still up 23% year to date. The big laggards, gold's down 7.93%. Disney still challenged a little bit, down 6.6%. Dividend yield portfolio, which year to date is our strongest portfolio, still up 15.8% year to date. But in September, once again, we felt some pain there, 4.82%, kind of right in line with the markets. Our big gainer, McDonald's, up 1.54% for the month. Our laggards, Eaton down 11%, Caterpillar down 9%, 3M down 10%. And once again, in this portfolio, Cisco down 7.8%. Year-to-date gainers, Blackstone, we're still holding on to about 84.75% gain there. Prudential's up 40%. Waste Management up 28%. Eaton's up 26%. Our big laggards, Merck down 5.79, and that's after since the end of the month, Merck had about a 9% bump a couple days ago, so Merck's, that's back in the black. Verizon down 5%, Coke down 2%. In our price potential portfolio, this portfolio has held up the best last month. Believe it or not, it's our growth portfolio, only down 2.75% for the month. So, I love that number. It's kind of, gives some justification of why we've been doing what in there. Year to date, we're up 13.5%. Big gainer, Dollar Tree up 5.72%. It had about a 13% pop one of the last days of the month, so that was nice. CACI up 1.77. So not a lot of big gainers in September. Our laggards, Facebook down 10%. They're catching a little heat right now, so that could get a little deeper. Union Pacific down 9.6. Google down 8.3. WholeLogic down 6.75. Year to date, though, we're still up. S&P Global up 30%, Allstate up 18%, Edwards Life Sciences up 24%. So, there is more turnover in there. So we've had other big gainers, but they're already out of the portfolio. So that kind of puts where price potential is year to date. In our small cap portfolio, also fared better than the market itself, down 3.8% for the month. Year to date, we're still up 15%. There were some big gainers in September. Echo up 45%, Triumph Bank up 22%, Harbor Bank up 2.4%, Eventbrite up 7%. We've just did some rotating in the small cap portfolio. We've added a couple more small banks, which should participate in the rising rate environment. We'll see how that kind of plays out. Big laggards, Acme United down 18%, Green Brick down 17%, U.S. Lyman Mineral down about 17%. Year-to-date gainers, we're still sitting on Proficient up 142%, Atcore up 111%, Triumph Bank, once again, up 106%. So we have some big gainers in there. Our big laggards year-to-date that we still hold, Pros Holding down 30%, Green Brick down 10%, Allied Motion down 8%. So overall, our portfolios, I think, have held up pretty well. I like our positioning. We have to expect some more volatility, I think, for the next couple of weeks. Obviously, we get some resolution on the debt ceiling. We get some resolution from a legislative standpoint. I think we work through these kind of short-term issues. I think that will set us up for a strong end of the year.
Well, hopefully we can get back to focusing on the earnings.
Right.
And what are actual companies that make up the underlying market? How are they performing?
Exactly. And, from an earnings standpoint, we have our challenges, but we still have some good positives that are out there. So I'm not ready to get super defensive. I think we've been positioned, I wouldn't call it defensively, but kind of for the environment that we expected. One little note, and I just want to throw this out there. So this was a survey conducted by Vice. They surveyed 3,000 adults in late summer 2021, so in the last couple months. And this concerns me a little bit. 3 out of 4 American adults surveyed, so 74%, say they would sell out of the U.S. stock market if equity suffered a moderate or big decline.
Don't do that.
Yeah, that's absolutely the wrong thing to do. You would think people would have learned their lesson last year going through the COVID decline. People that stepped out thinking things were going to just continue to get worse, they ended up losing a lot of money. Unlikely they got in at any kind of decent prices, because by the time things were, things looked improving, the market had already moved. And I think that's that's the same thing. It's always, when things look the worst is not when you want to step out, because you never know when the bottom's going to be, and the market moves quickly. Mm-hmm. Money will rush in when we see weakness. Even through a bigger dislocation, money will come back in, and if you wait till the all clear sign, you're basically probably going to be buying at prices higher than what you sold out in. So that human nature to sell low and buy high is always there. And
in theory, it sounds really nice, but in practice,
right,
it
to
rarely
actually
ever
find
happens.
the bottom and have the guts to actually buy at the bottom is rare. We had a lot more people calling when things were down to take money out versus put money in. Now we did have a few people put money in, which was great. Yep. And the same thing, you'll think back at March 9th, 2009, when the S&P hit 666. There was nobody calling to put money in. It was people, this is going to get worse, I want to get everything out now. And, we'll do as much as we can to keep it from doing that,
Yep.
and that's not going to be our position. But the key is, we need to stay in. We like where we're positioned. There is going to be some bumps along the road, but ultimately we're in the right spots for the environment we're in. And also, we don't think this is, this correction is a correction. It's not the big one. We need to be closer to getting to a point of going into recession. That's when we'll have a true
But
market
even if we were going
rollover.
into recession, we're not selling completely out of equities.
No,
you have to be in the
that's
market
exactly right.
because companies earn profits and profits drive valuations. And as we've talked about with our clients, if you have any short-term liquidity needs, if you are bumping up against retirement, we already have a healthy amount of assets in liquid form, in either fixed income or credit funds, money that's being protected and ready for you. You do not need to sell out of equities because by and large, it's the best place to be, especially over the long term.
Absolutely. And, recession, there's a recession out there sometime in the next, probably 36 months, but it's not coming in the next 6 or 9 months. I just don't see that happening.
So as always, thank you for your trust. If you have any questions, please feel free to give us a call. We'll talk to you in another month. Have a great October.
Thank you.